Good afternoon or good evening, everybody. Hope everybody's doing well. Really appreciate you guys signing up for this. It was kind of last minute for us, with about 3 or 4 days notice. We're going to give everybody about 2 more minutes to log in. So we'll probably start at 6:34. John and I are very excited to have Anna Kelley, AKA REI Mom. I like to say mommy, but it's REI Mom. We both have known her for a very long time. We'll go over the bios in a little bit when everybody's on, but she has an enormous amount of experience in capital raising, in the debt markets, both national and international. Worked at some little tiny company called AIG for was like 75 years, something like that. I know it felt like that, but it was probably a little bit under 20 years. And then, of course, we have John, the economist, on labs. And so we'll get started in just a minute. And in case you're wondering, yes, this is about new development and why new development seems to be rapidly growing in certain markets, why we're excited about it, and kind of how you can significantly de-risk opportunities in new development, and kind of what people should and shouldn't be looking for. Let's see who's on. I like to call people out sometimes. And then many of you have asked about our Facebook shots in the morning from Lifetime Fitness in Frisco. That's Frisco, Texas, not San Francisco. And if anybody would like to join, 7:30 in the mornings. Requirement is you have to be able to do as many pull-ups as John Montero. And I think the old man is up to 22. As he says, strict pull-ups. Don't even know what that is because I'm not doing one of them. But it's pretty fun. We do actually get together, talk about deals, talk about the best practices. But you got to work out first, body and mind. All right, so I'm going to get started. Again, good evening, everybody. We have myself, Meryl Calliser, John Montero, and Anna Kelley. And we're very excited about this. We actually had over 600 RSVPs. We only can hold 500, but everybody will get a copy of this. Typically get it first thing in the morning. If Jeff can't get to it tonight, take about an hour to go through. So this is about, someone already told me that there's a typo in the very first slide. This is about navigating multifamily development in 2022. That's supposed to be navigating. Like I said, we were in a hurry to put this together and beyond. So John and I, for those of you who don't know, we have Revision Masters, which is a company we formed about a year ago and have been partnering with each other ever since. We'll get into that in a minute. And I just want to remind everybody, the information contained herein is for educational purposes only. The presentation is not intended as legal or tax advice. You are encouraged to reach out to your legal and or tax professional for such advice. And if you choose to reach out to your legal, Calliser and Associates would love to provide you legal advice. Shameless plug. Jeff, next slide. I'm not going to read through the table of contents, but I just want everybody to see this is what we're going to be going over tonight. It's not going to be a long webinar. Most of you will be able to watch the football game tonight if you just so desire. But we've got about 8 topics that we'll go through. Very excited to talk about it, and we'll move on. Jeff, next slide. So I'll start off on the bio side since I'm already talking. Again, I'm Meryl Calliser. I'm a licensed real estate and SEC lawyer in the state of Texas, based out of Frisco, Texas. I've got a law firm with 2 other lawyers, paralegal, and CPA. And we typically represent 300 plus real estate syndications a year, mostly on the buy side, probably 10 or 15% on the sell side. And then we have all of our deals kind of aggregated together, but I've been involved in the single family rental arena for 8 years, got out of it in 2019, aggregated with a bunch of hedge funds, and we got over 9,500 properties. That was fun. Never do that one again. And then partnering with John over the last year, we've picked up about 6,700 units out of that 8,800 as managers or co-managers. And we've got together, we've picked up, we have 8 development projects or 9 development projects going on right now in some phase or fashion. I'll pass the baton on to John.
Thanks, Merrill. Appreciate everyone joining us this evening. My name is John Montero. I'm also based here in Frisco, Texas, just north of Dallas. Moved here in 2009 in the depths of the last recession. Why did we move here? Me and my family, we moved here for opportunity. So over the last 12 years being here, I've been doing full-time real estate. It's been a great move for myself and my family. The real estate market and just Texas in general, the economy, jobs, population over the last 12 years has been on fire for those who are familiar with the market or live here. I'm an econ major, an MBA is my background, it's my education. Like I said, I've been investing in real estate for 25 years, full-time since moving here to Frisco. Focus primarily on both the acquisitions of A and B class multifamily assets in Texas, as well as ground up construction. So we'll be focusing a lot of our conversation today about new construction, why we think it's a great opportunity, what our methodology is on how we de-risk our projects for ourselves and for our investors, and then ultimately kind of talk about what we got in the pipeline. So with that, I'll hand it over to Anna.
Great. Thank you, John. So my name is Anna Kelley. I'm with Greater Purpose Capital. And my background, as Merrill alluded to, has not been 75 years at AIG, but I did work for AIG for 20 years in the affluent and corporate markets group, where we developed hedge fund investments for ultra high net worth individuals, corporations, and banks. Before that, I was in private banking and was the top relationship manager for Bank of America in Texas, where I am from. And on the side, I started investing in real estate. So I bought my first property 24 years ago. Now I'm full-time in real estate and own about $250 million in multifamily across Texas, Pennsylvania, Florida, Tennessee, and Maryland, myself, and also with other partners. I am a speaker and real estate coach through REI Mom and an Amazon #1 best-selling author. I love helping people to understand real estate and investments, and I'm honored to be here tonight.
Merrill, before you move to the next slide, I just wanted to kind of say one other thing. You know, I'm excited. We're super excited, obviously, to partner with Merrill and Anna on these projects. And I think as you kind of look at as an investor, and I do it myself, I'm an investor in a lot of different projects. I always talk about team first, market second, and asset third in that particular order. And basically what that means is, as you're analyzing opportunities, what I always do is look at the team first before I look at the asset or the offering to see whether or not I align with the sponsor team, whether they've got the experience and whether they've got the track record. I can say with confidence that the three of us have been doing this a long time. We've been through multiple real estate cycles, multiple economic cycles, and I think combined, we probably have close to 75 years of real estate experience. So again, we're super excited to be able to partner with these phenomenal team members, and I'll hand it back over to Merrill.
Great, and I'm going to hand it over to you, John, I think.
Oh, am I next? Okay.
Economic update. That was quick for me.
Yeah, so I'm going to go over a couple slides here fairly quickly and then hand it over to Anna to wrap up the economic outlook section. So next slide, please, Jeff. This is from IPA, which is a Marcus and Millichap division. It basically shows that we have a structural shortage housing problem here in the United States. This is nationwide. You can see that ever since the Great Recession in 2008, we have just not built enough housing to support the population growth in this country, whether it's single family or multifamily. So we've got a severe under supply of housing that we've had for the last decade. And we even have a bigger problem here in Texas. So again, this slide is about the United States in general. Here in Texas, it's even worse. We've got a chronic housing shortage in Texas in all of the major metropolitan areas of DFW, Austin, San Antonio, and Houston. And even though this state is extremely pro-growth, it is extremely difficult for home builders and multifamily developers to keep up with the amount of job and population growth that we have seen over the last decade and what we forecast to see over the next decade going forward. Currently, actually in 2020, the Texas population was approximately 29 million people. It's forecasted by 2030, which is really only 7 years away, the population is expected to be up to 35 million. So within a decade, that's an additional 6 million people moving here to this state. And so again, that is just going to create additional housing shortage with all the amount of people and jobs moving into the state. Next slide, please. This talks about the cost to rent versus the cost to own a home. As you can see, that spread between the cost to rent versus the cost to own has continued to widen significantly since 2012 and has really kind of widened over the last 2 years. Actually, we tracked this on a monthly basis, and this exact slide from Marcus and Millichap, literally a few months ago, the spread was $638 per month. It is now up to 1,000, and it could continue to increase, and we'll talk about why in a second. Next slide. This is one of the reasons why that spread is occurring. So as you can see on the left-hand side graph, there has been price increase for both single-family homes as well as condominiums, again, since 2012. And the real acceleration of price increases have occurred from COVID up until today. 10% year-over-year change. You can see that it's kind of slowing that trend line now, but yet, the cost to own a home has gone up significantly across the country. On the right-hand side, you'll see that the existing home sales has started to decrease. So there's a negative 20% year-over-year change in home sales. And that's primarily due to two things. One, it's becoming much more expensive and becoming out of reach for first-time home buyers. The slide on the graph on the left. And the other thing that's not shown here, but we all, I'm sure, have been keeping track of it, is that the interest rates for 30-year home mortgages has skyrocketed since the beginning of the year. It was in the 3s, and now, as of today, the 30-year home mortgage is at 6.9%, just under 7%. So you combine those two things of increased home prices and increased debt service, that really causes that drop off in the existing home sales. Next slide.
So great. I'm going to take over for John from here and talk a little bit about the multifamily demand story. And as John spoke about, housing has had a shortage for quite some time, and the amount of apartment units needed has skyrocketed in the last several years. You can look at historical demand over the last 25 years or so, and we have record strong demand at this point. And all of that demand is really pushing our vacancies to an extremely low level, all-time low of 2.4%, which is pretty incredible given that we've underwritten most deals at a 5 to 10% historically, depending on the location. We do expect to see continued growth and demand for apartments over time, especially in Sunbelt markets and particularly in Texas. And part of the reason for that is that we just continue to have an unaffordability issue. I've looked at housing prices as a percentage of incomes back to the 1960s. And as of this year, we are actually the second least affordable year in over 60 years. And so that's just going to continue to make people have to rent from in apartments, and those that can't afford a home still want nice homes with nice amenities. Next slide, please. So along with that comes strong rent growth and population growth that is driving rents up and driving the need for apartments. Rent growth has been really strong over the entire country across Class A, Class B, and Class C apartment buildings, with over 17% annualized rent year over year for the last year. And if you look at Class A multifamily, it's been 17.7%. Although the level of growth may come down and we see a little bit of that slowing, we will still be primed for high growth, especially in some of the Sun Belt and Mountain Desert regions. If you look at the graphic on the left, you'll see that young adult population, who are our primary apartment renters, one of the largest demographics, are really flocking to the Mountain and Sun Belt areas. Dallas-Fort Worth is actually in the top 10 markets in the nation, and Texas as a whole had 2 million people move to Texas for jobs over the last year, and it's the #1 state for migration for millennials, which is an important demographic for apartment owners. Next slide, please. So I want to talk a little bit about cap rate convergence, what that means and why it is good for us. Essentially, a cap rate is the rate of return that investors demand for the risk of taking on an asset over and above a U.S. Treasury. And the higher the risk of the property, the higher the cap rate, the higher price someone wants to pay for that asset. And so if you look back at a delta between Class A multifamily, new properties and really strong, robust markets versus Class C properties that might be in a tertiary or a secondary market, workforce housing that's a little bit older, that's going to have some deferred maintenance, because those properties have more risk of not being able to generate the income or sell at a top price, the delta between Class A and C has typically been quite large. And so if you go back a decade, you can see that the cap rate difference between Class A and Class C multifamily was 625 basis points. But what we've seen over time, as investors are chasing yield and not able to make the returns that they want in Class A, they've been highly competitive going after less quality assets, those Class B and Class C assets. They have been chasing yield, and doing so, they're willing to take on a little more risk, but they're paying more and more to get into those opportunities at all, which results in a convergence of the cap rate. So if you look back to 2015 and 2016, you'll see that the delta between entrance caps is only 250 basis points. And over the last 4 years, we're down to a 50 basis point gap, which means investors are paying significantly more for riskier value add, heavier value add deals in not quite as strong markets with older assets, which creates significant risk of execution, being able to perform on that value add and still exit. So it is a strong opportunity for us to come in today, develop Class A multifamily with a much more similar risk profile as what the spread was in the past versus what it is today. One other thing I'd like to point out, when you look at economic crises or recessions, what you'll see is that institutions want a flight to safety. And so they go for Class A assets, even during recessions. And if you look back at 2010, some people are worried about cap rates expanding, but you can see after the Great Recession, cap rates for quality Class A assets actually went down quite significantly. And so what we do know is on a Class A quality institutional level asset, once we build it, we'll always be able to get top dollar compared to having to speculate a little more on Class B or C value add deals. I'll hand it back over to John.
Hey, Anna, real quick.
Sure.
Sorry. So I also wanted to point out on that chart that that's a national average. So what we see in Texas, the cap rates are significantly lower even still, but the trend is the exact same. But we haven't seen 5.7% for Class A probably ever. If we have, it's been a long time. It's still floating around 4%, maybe 4.25%. But I just wanted to point out that most of these charts right here are based on national, not necessarily submarkets, markets.
And they're 3 years. They're 3 years in arrears as well. So before you change the slide, Jeff, let me just add a couple more things. So as a result of this, we track a lot of data, and we've been in the market long enough to see that cap rate compression between C, B, A class, and new development. And so as we kind of 7 years ago looked at the spread where the cost to build pretty much is the same as the cost to buy, and in some markets and some assets, it's even more expensive to buy existing assets than it is to build. Even with all of the cost of construction, increases in labor, supply chain problems, we've still seen that in many instances, it's cheaper to build than it is to buy. And so that's another reason why we've really kind of taken a look at new development and has, in addition to acquisitions, focus on that for ourselves and our investors. So next slide, please. So this is a really important slide in terms of how we look at mitigating risk associated with new development. When I talk to a lot of investors and a lot of people in real estate, they say that new development is extremely risky, and it can be if you do not de-risk the project in a way where you are removing a lot of different potential risk points as you move through the project. And so I just want to spend a second and talk about the 4 risk buckets that we look at on every single project. And if I can't check the box, or if we can't check the box and get comfortable with all 4 of these risk buckets, we're not going to do the deal. So that's number 1. Number 2, I'll talk about in a second as to when we actually bring outside capital in these projects, again, to de-risk that entitlement piece that I'll talk about here in a second. So the first entitlement is the first risk bucket is entitlement risk. So basically, when you buy a piece of land or a piece of dirt, you have to get it entitled, right? It might be zoned agricultural, and so you've got to get it through zoning, you got to get it through entitlements, and in doing so, you've got to really have the knowledge and understanding on working with cities and counties, with planning and zoning, with city council, with engineering, et cetera, to basically know that we're able to build what we want to build on that particular piece of dirt. So entitlement risk is the first piece. The second one is, once you have permits in hand, what's the financing risk? Are we, as sponsor teams, able to put the capital stack together, both the debt and the equity? If we feel like we can do that, then we're going to move on to the third risk bucket, which is execution risk. So we have the capital in place, we're starting to build. And at that point, what is the risk around execution? As long as you've got the right team in place, the right GCs, owner's rep, architect, engineer, sponsor team, our goal is to basically build on time and on budget, so that we are able to de-risk as much as possible that execution risk. And finally, the acquisition and or exit risk, which basically means once we've got it at certificate of occupancy, we've got it leased up, what does that environment, what does that economy, what does that market look like in 3 to 4 years from now when we're done, where we can either refinance it and move into permanent debt or sell it on the open market. Again, nobody has a crystal ball, but we feel that the markets that we're targeting, and we'll get to those in a minute, that we feel like whether we're still in a downturn or whether we're back up and booming again in 3 to 4 years, we're in the right markets where it's the fundamentals of supply and demand that we talked about earlier that will continue to remain in place at the end when we're ready to exit. Before I move on, one last thing going back to entitlement risk. And as you guys, as investors, look at different development opportunities, you need to ask the sponsor team or the deal whether your money, whether your investment is put in towards just acquiring the land, and then they're going to go and try and get entitlements, or is your money actually going to be put in place to actually build once we have entitlements in place? And so we pride ourselves that we do not bring in any outside capital, whether it's debt and or equity, into our projects until we have permits in hand or we have entitlements in place. So that de-risks the most riskiest part of a development, which is the entitlement piece. Meryl and I and Anna, we are the ones that are fronting all the money associated with getting these entitlements. We're paying engineering bills, we're paying architect bills, we're paying city fees, surveys, tree studies, traffic studies, environmental studies, the list goes on. And we want to do all that on our dime to know for a fact that when we're ready to talk to outside capital, debt and equity, that we're actually going to be able to build what we plan on building in a very, very timely manner. So hopefully all that makes sense. I'm going to move on to the next slide, please.
Hold on, before the next slide. This is going to be like this for the rest of the 30 minutes. But just to capitalize on what John was saying, essentially what he's saying is our business model is not to land speculate. We're not necessarily saying that's not a good business model for those listening. We're giving you the ideas and the structure that we utilize to go after land to then create multifamily developments on. But we do know, and I do have clients that do it the other way. I think one of the key points on the risk number one, which from our perspective is the biggest risk, is I do have clients and know people that have picked up land in a potentially really good area 3 or 4 years ago and still have not been able to push through zoning. So what happens is most of the time that's picked up with, or many times that's picked up with debt and investor capital. And there's got to be a way to service the debt, and you're not cash flowing anything, and you didn't anticipate sitting on the land that long. So that becomes a problem, potentially capital calls. And then you have investors, they get very nervous waiting, even though initially they wanted to get into it. They didn't think they were going to be waiting that long. So when John says we put our own capital up front, it's a big deal, because many times we're still under contract and we're putting capital up front. We've got a due diligence period, and one deal we're in $700,000, another deal we're in $300,000 or $400,000, and we haven't even closed on the deals yet. So we're truly de-risking the entitlement phase, and we understand that if we can't get it zoned right, we lose the deal, we lose our money. That's our risk, not our investors or debtors' risk. And so when you're looking at doing new development, you want to, I would think you would want to run through the same type of 4 risk buckets. This is John's slide. I've probably heard it a billion times over the last 12 months. So I hear it in my sleep now. But I mean, this right here, these 4 buckets, this is make or break a deal. You don't have to do a whole lot of underwriting to run through these fairly quickly and decide, does this make sense to even move forward to underwriting a potential land opportunity? This is a good discussion, John. Jeff, let's go to the next slide. So this is just a cover slide, but I'm just going to talk about why new development now. We kind of have been talking about what the markets have been doing so far. Just for eye candy, we put a couple of our own deals, and I just talked about it for a second, not necessarily the deals or investing in the deals, but when you do your own new development deal, the nice thing is you get to design it exactly the way you want it, as opposed to buying someone else's design that's older, that may have been a great design and very efficient 30 years ago, but now is obsolete. So between designing amenities and adding car chargers and, you know, little dog parks, big dog parks, medium-sized dog parks, dog washing stations, all sorts of things that make, as Anna said earlier on, people that can't get into homes, makes it feel more like a home. It's very amenitized. So these are just pictures. So next site plans. Next slide, please. Okay, so we're just going to touch on. I'm going to touch on very briefly what Anna and John were already touching on, comparing kind of BC value add versus development, because even today, BC value add can still be a good opportunity if you find the right location, the right partnership, right location, right debt, very similar risk buckets, but understanding that to buy that B class, if you're in Texas, you're going to probably spend the same, if not more, as doing a new development. So your return profile typically is going to be higher on new development than on B2C, because you're buying at a relatively low basis. You're typically building A class. You're going to get top of the market rents where you are, and you're going to be able to move that much quicker once it's stabilized, if that's your exit strategy. From a risk profile, they're probably pretty even. Especially, I would say they're even if you go through our 4 risk buckets and you de-risk. If you don't go through the 4 risk buckets, and especially risk bucket number 1, they're definitely not even. The development would be significantly riskier. Capital return quickly. We've got it a little better on the development side. Typically, it's going to take you 2.5 to 3 years to develop. Other than the last year where we had a massive compression, or last year and a half, a massive compression of cap rates. Typically, deals were lasting 5 years before investors were getting their money back, and it's probably going to be similar to that going forward for the next 2 or 3 years as sponsors buy new deals. But when you're doing development or new development, you have a construction loan, and that construction loan is finite. It's typically 3 years plus a 1-year extension. So you will be either recapitalizing and paying your equity back, or you will just sell it upon stabilization and pay your equity back. So there's more certainty of when you anticipate closing. Of course, that's subject to market conditions, but that's typically how you structure the development deal. Access to quality markets, that's kind of a given. You're going to have more access to quality markets if you're picking the land. If you're choosing where you want to build, hopefully you as a sponsor are choosing a quality market. Access to quality assets, I'm not even sure why that's on this chart, because you're going to choose your assets. So again, I don't know of anybody who is building new C-class assets. John, I don't think you do either.
Nope.
Doesn't make a whole lot of sense, because the difference in cost is not that much. And you're certainly not going to get the increase in rents, but you do, obviously, you control the quality of your asset based on the amenities, the finish out, the size. That's basically an off-market deal flow. That's almost non-existent on BC value add, because the brokers are doing what they're supposed to be doing. They're going to try to maximize the potential value that they get on an offer, so they're going to send it to as many people as possible. On the development side, you don't really have to worry about it much. Most of the time, as John mentioned, we don't search for land. It comes looking for us, not it, but the owners or a friend of the owner. So every one of our opportunities has been an off-market deal. We get on-market opportunities, but they typically don't pencil out for us. Crowded marketplace, that's a no-brainer. A lot of people are still chasing B and C value add, and we look for B and C value add, primarily B value add if it exists. It's tight right now. There is an imbalance between what sellers want to get for their property and what buyers want to pay, primarily because of the debt. But then on the crowded marketplace, it's not that crowded on the development side. There are not a lot of teams that can put together a plan, a course of action, go through the 4 risk buckets and actually get the job done, nor are there that many that want to put that much capital at risk in risk bucket 1. So from our perspective, it makes the opportunities larger for us. There are more opportunities, but as anything else, it's riskier for us, not for our investors, for us on the first risk bucket. Creative deal structuring. Everybody knows kind of how B and C's work. You buy it, you typically you're going to renovate 2/3 of it. You leave 1/3 for the next group coming on. So meat on the bone. You hold it for 3 or 4 years. You prove the model out, and you sell it. On new development, it's very interesting. You can buy the land. Typically, you're buying or putting under contract as raw land. You may get it entitled. Maybe you buy it for $6, $7, $8 a square foot. You get it entitled. You turn around and you flip it for 12 or 13 a square foot. Call it a day. Or you could go ahead and develop it, get permits in hand, and be just about ready to move dirt, and you may get a couple more bucks a square foot from a potential buyer. Or you can do it in phases, or at the end, once you've constructed your multifamily and you're in lease up, you can sell it on the open market. You can sell it to yourselves. You can recapitalize it. You have numerous options depending on what the market conditions are. And then finally, on this chart, probably the second most important thing that the 3 of us look at is path of progress. path of progress is kind of getting ahead or right at the front line of where all the growth is going. Follow where the companies are moving their headquarters. It's very easy if you live in Texas to do that. And there's some other markets like North Carolina and Florida and Georgia that are getting major companies coming in near MSAs. You follow those markets, you try to get ahead. It's great. Samsung, Texas Instruments, they announced they're doing $30 billion complex, $19 billion complex. The good thing for us, those of us that are into developing, that gives us 3 or 4 years to get our asset in line, everything in place so that we deliver at the same time they deliver. And so who wouldn't want to work relatively close to their job, especially people coming from out of state that aren't going to know the markets as well. They're going to want to be closer to their job. Next slide. This one's much easier for me to go over. This one kind of speaks for itself. So we're just showing the energy and commodity prices trending. This slide has probably been on 5 or 6 different presentations, Mark's Millichap, several lenders I've seen it on, but it still is very good if you're in the development side. So John and I and Anna get questions all the time, you know, isn't lumber price too high? Isn't lumber too high to build right now? I heard steel is too high. So, and then copper to a lesser extent. There's still a lot of copper in, but that's not your major expense on the material side, but the major expenses are lumber and steel. And yes, there was a huge spike of lumber and steel about 6 months ago. But if you look at it now, for example, lumber is basically sitting at the same rate it's been since January of 2019, maybe a tiny bit higher. So while certain factors are causing, inflation is causing the cost of labor to go up, and other materials, key materials like lumber, which is typically 10 to 15%, could be even more of your cost to build, is in a downward trend. And some of the latest reports coming out are showing it's going to continue to go down because they're building less homes in the country in general. Less home starts are forecasted because of the cost to afford a home with current financing. So that's going to actually make lumber even potentially more affordable for us. And then steel is another big commodity, and it's down almost 50%, and it's being driven down too for the same reasons. And then copper is still a little high, but it's not too far off. You're under $4 per pound, and typically it trades around $3 to $2.90 a pound. So one of the things that we like is, yes, we have inflation. Arguably, depending on who you talk to and where you live, there's a recession going on in the country. I would argue that it's not going on in every market, but it's clearly going on in a majority of the country when you look at the national numbers. But that is not necessarily a hindrance to go out and develop. The key terms, the key costs for materials in many of these spots are going down. Again, labor is up. There's no question about that. So let's go to the next slide. Okay, so this is something that probably many of you don't know about. Most of the people on here, at least we kind of pre-screened everybody ahead of time, those that we knew, are involved in multifamily syndications. The typical multifamily syndication where you're buying an existing asset, you renovate it, you add some CapEx, you stabilize it. Those are all subjected to bonus depreciation. Everybody's excited about accelerated bonus depreciation, especially this year being the last year that you can, if it's available to you, you can utilize 100% of it. It does start to drop off 20% at a time. It goes to 80 next year, 60, 40, 20. Now, new development. You can't get bonus depreciation unless you've got something actually developed. So there's no depreciation on land, and there isn't any on land anyway in existing. And it typically on a 300 unit project, it's going to take a year and a half, 2 years after you have the horizontal to fully complete it. So you wouldn't even be available to get bonus depreciation for 3 years out. So many people rely on the bonus depreciation as a hedge against taxes or deferring taxes to a later date, offsetting it. So one of the things that excite us about new development, and especially with some of the new act that was that's been proposed by Biden, are various tax deductions and tax credits that are solely in regards to new development. So I'll have everybody sleeping. I already see some people yawning the moment I say tax. So I'm just going to go over this very, very briefly. Long story short, when you're doing new development, the government is giving you, this is 179D. There are two sections. So this is section 179D. You get a tax deduction. A tax deduction is up to $5 per square foot based on two things: energy efficiency and labor rates. Energy efficiency is self-explanatory. The government is encouraging, especially in areas where it's not being pushed, to build energy efficient housing. That's for obviously the tenant. It's for the market area it's in, so it doesn't put a huge strain on the energy reserves. So luckily for markets like that we like, DFW, Houston, Austin, San Antonio, the codes that are required are for the most part already up to par with this. There may be a few things that we would add that are in the act to make sure we get it. So if you meet just the minimum, you get 50 cents per square foot times 25%. So basically it's $2.50 is where it starts at per square foot. So that's a tax deduction on an average 400 unit apartment complex. That could be 500,000 square feet. So you're going to get 500,000 times $2.50 as a tax deduction. Now, what is very interesting, and we're not going to get political on this at all. However, the current government put some standards in to allow you to get even more, to basically double that $2.50 to $5 based on the labor rates of the laborers that are developing the project. So downside, you've got to have an accounting of it, probably an audit of your GC and your subs. But if they hit the standard labor rates, and this is the great thing, they haven't been set yet because this starts in 2023. But rest assured, they will be set. And we're hoping they're not California labor rates. They're more like Texas labor rates, but we'll see what that, hopefully they've got it right. It's geographical, but we'll see what happens. But anyway, you can get up to $5 per square foot. So $5 per square foot times 500,000, that's 2.5 million in a tax deduction that you get to disperse amongst the investors and the GP, subject to those that are eligible to take it. I believe it's going to be very similar to the bonus depreciation. Self-directed IRAs aren't going to be able to take it. Roths won't be able to take it. But again, as I said in the beginning, definitely reach out to your tax consultant. We know a little bit. We play like one on TV, but this is for educational purposes only. Jeff, next slide. So this is the other one. So this is now this is fun. So this is an actual tax credit. It's funny because this actually has already been around. The difference was they didn't have labor rates. So up until, well, through this year, any new construction that you built, and I believe it was garden style 3-story. So 3-story garden style up until this year, the end of this year, you got a $2,500 tax credit per leased up unit. Okay. So you build 300 units and the end of the first year, you lease up 200 units. Hopefully you're doing better than that. But let's just say lease up 200 units. So you would receive 200 times 2,500, which is 200 times 2,500, 5 million. I think it's 5 million. Doing my lawyer math in my head. I think it's 5 million, either 5 million or 500,000. I think it's 5 million in tax credits. Someone will correct me if I'm wrong. But I believe it's 5 million. So you would receive that in tax credits. So what they did this year or going forward for 2023 in the same act. So you have the deduction on the prior slide. You also have a tax credit. And for those that aren't sure the difference between deduction and a credit is a dollar for dollar offset. That's more lucrative than a deduction. No one's going to turn down a deduction, but a credit is if I owe $100,000 in taxes and I get a credit based on my ownership interest of $50,000 in tax credits, I'm only paying $50,000 in taxes versus I'm going to reduce my income by a certain amount of expense. It reduces your tax burden less than a credit. So hopefully I didn't confuse anybody. Easy to remember. Thank you. Someone told me it was 500,000 as a tax credit versus 5 million. Lawyer math, and I don't have my calculator in front of me. So $500,000 is probably equivalent to more like $1.5 million in a tax deduction. You know, assuming you're in a 35% tax bracket. So in this scenario, let's say you have those same labor rates that qualified you for the prior tax deduction. You can get under the multifamily, you can get up to, again, subject to energy and labor rates, up to $5,000 tax credit per deal. So if you're in a 400 unit deal and you have 5,000, you have met the requirements, you get $2 million tax credit that gets dispersed amongst the investors and the GP. That is huge. Again, if we're assuming like a 30-35% tax bracket, maybe higher depending on where you live. But if it's 30-35, basically take that number times 3. So that's like a $6 million deduction. And if you're in a deal, and again, this is for sponsors to decide. We talked about optionality. There are different options when you're developing multifamily. If you decide to keep everybody in the deal, recapitalize with less expensive debt, longer term debt, you're paying some capital back. So they get the benefit of this deduction on the prior slide. They get the benefit of the credit. And guess what? Now they're going to get the benefit of the depreciation expense. Totally different expense. No, they're not going to, end up with making money off taxes, but it's significant tax savings. So it's something that's not really discussed. And I'll be honest with you, this is new to me as of about 10 months ago, because I was very disappointed that we couldn't get deductions. And you'll see a little, you may hear about it later, but we rely heavily on a company called ETS, Engineered Tax Services. And so they just did an incredible webinar 4 or 5 days ago. You can probably Google it and find it. Again, it's ETS, about these two credits and deductions. And actually, if you're interested, email one of us and we can send you a 10-page PDF flyer that they sent to us. So we will be engaging them. They have to do a study. And yes, you have to pay for it like you pay for anything else, but I'll gladly pay for something that's going to give us potentially a $2 million tax credit and another $1.5 million tax deduction. So enough of Merrill rambling. Next slide.
Merrill, I want to just add one thing real quick to that in terms of the tax credit. So unlike bonus depreciation, which has to be recaptured at some point, tax credits do not. And so it's actually more favorable, one, because it's a dollar for dollar, like you said, but you get it, it's once and done. You don't have to pay it back. So that's a huge benefit for development in this program.
And that's a very good point. So, and we've already decided on our exit strategies on our deals. If we are going through the lease up and then the option is to sell on the open market or sell to ourselves, we are not going to elect for accelerated bonus depreciation, because all we would be doing is essentially giving people a deduction on their taxes this year that's going to have 95% recapture next year when it sells. So we did not put our investors really in any better position. So that's something as a sponsor you need to think about. And again, I didn't focus on that on the last 2 slides really until the very end, because it's not something we would anticipate doing unless, let's say, market conditions made it such that the cap rate to sell isn't very good, but these are great cash flowing properties. So we get a nice agency loan on the deal. And yes, you're going to get the benefit of 3 different types of tax deferral or tax abatement. So there's lots of options on it. But when you're doing these, if you're exploring these, that should be key in your presentation to your investors. Is aside from what they ultimately get, remember, these are not cash flowing properties until they're leased up. If you hold it beyond lease up, they're cash flowing. So the investor is banking on a lump sum at the end of the day, and they sure would like to have some sort of offsetting tax benefit on that lump sum. Well, you just teed it up for them. Sorry, Anna. Which leads into Anna, who is doing the next slide. And we'll stay on this slide, Jeff.
Yes, so we're going to talk about where we're developing Texas and why we're developing in Texas primarily right now. So the primary story is really jobs, jobs, jobs. And so as John alluded to earlier, there are many large corporations that are relocating to Texas for various reasons. And the four primary are the taxes, the tax scheme in Texas, affordability, corporate rents, and the location of Texas. And so from a tax standpoint, Texas has a combined corporate tax rate, which is 21%. It's among the lowest, if not the lowest, in the United States. And this lower tax bracket can result in about a 5 to 7% increase in corporate profits. And in a time when corporate profits are already squeezed, it makes a huge difference when corporations are looking for where to relocate. It's also very, very affordable for workers that work for these corporations. And so the cost of a single family home, for example, in a major metro in Texas is less than half of a home in New York, Los Angeles, and Washington, D.C., other major employment hubs historically, and also significantly less expensive than Atlanta, Georgia, for example, where there's a lot of job growth as well, Chicago, Illinois, or Miami. It's also less expensive for the corporation to do business in general because of the location of Texas being central to the country when you're looking west to east, and there being a lot of high quality airports. Business travel is very inexpensive and very fast. You can get just about anywhere in a couple of hours. And that's really important for companies that are flying, people back and forth or have multiple offices. And then corporate rents are much, much lower in Texas. In fact, they're about half of what corporate rents are in Chicago, LA, or Washington, D.C., and nearly a third compared to New York City. So it's much more competitive and a lower cost of doing business in Texas. Next slide.
Can we real quick before you go to the next slide? So I read this morning, it's very interesting, in the Wall Street Journal. It was either this morning or yesterday, talking about this. So in the Wall Street Journal, like if somebody posted somebody did. Anyway, regardless, they were talking about how Texas from last year, this year, increased the average salary by 10.9%. But yet housing was still 17.8% lower than the national average. So I'm sorry, the salaries were 10.9% above the national average, and housing is 17.1% below the national average. So aside from not location, but jobs, people are moving here because of that difference on top of all the companies coming. And that's probably why the companies are coming here too, as you alluded to. They know they can get quality people here. It's not like they have to twist their arm to come to a state like Texas.
Absolutely. Yeah, next slide, and we'll talk a little bit more about that as well. So to Meryl, to your point, there are 14 million people in the civilian labor force in Texas, and that just continues to go up. But in addition to that, the average worker, 90% of high school students actually graduate high school, which is among the top 5 highest in the entire nation. So they're slightly more educated in Texas, and there's a lot of workforce, and they just continue to come. So Texas, a lot of people don't realize, actually has the 9th largest economy in the entire world. Being from Texas, I used to say I was from the great country of Texas, and literally Texas, by both land, population, and economy, is larger than most countries in the world, which is pretty incredible. We are the number 1 U.S. exporter for over 20 years in a row at $375 billion in exports in 2021. Texas is the leading destination for companies relocating from other states, in large in part because of the labor force, because of the things we talked about on the first slide. But Texas is always also very big on infrastructure. There are 11 international highways, 26 commercial airports, 16 seaports, foreign trade zones, 624 miles of coastline, and 46 freight railroads. And they're continuing to expand their highway systems to allow for continued growth, which is really important to those employers. Texas also led the nation in high-tech exports for the 9th consecutive year. And there are a lot of high-tech employees working in Texas for major Fortune 500 companies. The slide says there are 49 Fortune 500 companies, but 2 more just moved to Texas. So there's now 51 major Fortune 500 companies. And there are 200 corporations looking to move to Texas in the next couple of years, according to the most recent stat that I read on a Texas Employment Bureau. They are the leading job creator in the country. In 2021, Texas added over 700,000 jobs. So when Merrill talks about this path of progress, as these companies continue to announce that they're building in Texas, more and more people come because they know they're going to have much higher wages at these Fortune 500 companies. And again, much more affordable housing. And so when you combine that, the cost of living for someone in Texas who's making high quality, high paying incomes and having more affordable housing just allows that economy to continue to be robust, even in a recession. So whether we're in a recession, whether we're not technically in one yet, but we're headed there, Texas is really uniquely positioned to be very resilient through all economic times, whether it's inflation or recession, because of the robust jobs, the quality of the employers, the wages, and the cost of living. It's really primed to continue to do well over time, over the long time. And it's one of the reasons we're very bullish on that market. And when we talk about cap rates, it's one of the reasons that large institutional investors invest in major cities, Class A and major cities, because they want the robustness of the economy that supports that asset. And like John said at the beginning of our call, it's team, then market, then asset. You can have a great new asset and a team that's in a terrible market, and it's gonna have some pain during a recession. But a robust economy like Texas, and in particular in some of the cities that we're looking in, really is primed for economic strength, which bodes well for both our rents, our incomes, and exit cap rates being much more favorable, being able to, command higher prices when we do go to exit. Next slide. I'll turn it over to you, John.
Okay, thanks. So over the last hour, we've been able to share with you why we like Texas, why we are bullish on the fundamentals of multifamily, and ultimately why we think new development is a great way to take advantage of all of this potential growth. So this is a map of the triangle of Texas, Dallas, Houston, Austin, and San Antonio. And we currently have 9 projects running right now in various stages of the development process. We have at the top there 4 projects in the DFW Metroplex. We have 1 in Austin, and then we have 4 projects currently in the Houston market. Next slide will actually show as to the areas of our focus and the methodology as to why we picked these 9 different projects that we're currently working on. Next slide, please. So what do we look for in a good piece of dirt and a location where we think there's going to be a great opportunity to build multifamily? Besides all of the fundamentals around demand and supply, which we've talked about on multiple slides, we basically are pretty clear on the areas that we focus on. So I'm going to first go to the maps on the right-hand side first. In DFW, where our focus is primarily north and northeast, that's the area where we are seeing the largest population growth happening with the highest income in the Metroplex. So that's where we're focused on currently in the DFW area. As you move down to the Houston area, we like to focus on north and west of Houston, everything ranging from Katy on the west all the way up to north of Woodlands and the Conroe. And then on the bottom map there in Austin, we really are focused primarily east of the city. That's where a lot of that tech and job growth is occurring with Samsung, Tesla, et cetera. That's where a lot of the growth is pushing east. So those are the areas that we're focused on. So, what do we look for when we're buying? Very high level, obviously location, location, location. We want to be in path of progress markets that when we're delivering our multifamily communities, that growth that is already pushing out that way will have caught up to us and we'll be at peak leasing season when we're able to deliver that product. We want to be in path of progress markets We typically look for acreage of anywhere between 12 to 30 acres. We only work on off-market opportunities, either directly with the landowner or with partners or associates that have a connection to the landowner. We work on long due diligence time periods. As we'd mentioned earlier, we want to de-risk the entitlements with the longest period possible so that we know that we're going to be able to build what we're planning on building. And then finally, no infill land. So what we don't do is do infill inside Dallas or inside Houston. We don't do high rise, mid rise. We want to be, again, in that path of progress, garden style 3 and 4 story multifamily communities. And I'll just leave out with the partnering piece here. All of our 9 projects that you just saw on the last slide, we have partners on every single one of these deals. Many times, partners that we know, colleagues, friends, know that we're in the development space, and they have a contact with the landowner, or they may own the land themselves, and they need some help and assistance in kind of bringing that project to life. And so, we have plenty of opportunities where perhaps there's an opportunity to sell the land to us as a group, free and clear. Maybe they can contribute the land as equity, or sell us the land at a discounted price and then retain an equity position in the opportunity as well. So don't want to spend too much time here, but if anybody out there has an opportunity that they're looking at or have a relationship with the landowner and want to have a conversation with us, you'll know how to reach out to us at the end of the presentation. Next slide.
Oh, that's me. Real quick, we just thought we'd put one of our deals that is actually, we're very excited today. It actually happened. We got permitting approval to start the horizontal. Our team's working on this one for 10 months, John?
Yep.
10 months. 10 months, went from, farmland to multifamily to annexing into the city and donating a new fire truck for the annexation. It's actually in the development agreement. We didn't donate, we paid for one. But this is pretty exciting. We've got a ton of people been asking when you guys have an opportunity. The opportunity is coming up soon. We're going through debt. We haven't talked too much about the debt market, but obviously the debt market's a little challenging. This one is very exciting to us. It's 480 units. That's the actual site plan. It will look a little more exciting than the CAD pictures below. But it'll be 480 units, 2 phases, but we'll pretty much run the phases back to back. Right in an incredibly booming part of Princeton, path of progress, middle school on one side, elementary within walking distance. We're very excited about it, but we're not going to go into too many details about it now. This is not a solicitation or an offering right now. Next slide, Jeff. However, just give you kind of the high level of kind of how we look at it. This is for phase 1 of the 240 units. So those of you that are interested in doing what we do, this is a very high level of what it costs and how we source this. We literally could do an entire webinar on sourcing debt for new construction, and it's fascinating. I think John and I have spent the last 6 weeks. I can't even tell you how many different lenders we've talked to and term sheets, and they are all over the board. But ultimately, we settled with a local bank, getting a really good 6% fixed rate. And then we're using a PACE lender on top of that, which is very interesting, relatively new, hard to find banks that like PACE because they're a second loan, but they actually have first position over the lender because they step in as a taxing authority. They have the same lien as a taxing authority. So you got to find lenders that are very comfortable with it. But as you can see below, we actually on this project have built the capital stack. So we have 80% of the capital stack at a 6% fixed rate. So that, I'm telling you, is an incredible rate. We're very excited about that. And then we've estimated that the private equity we're raising will be between 22 and 18%, depending on what class people come in at. Then you can see over on the right, we have the sources on the left, on the little graph on the little chart on the left. And then the uses is always fascinating, looking at the hard costs. I don't have lumber broken in there, but I think lumber is about 4 million, 3.5, 4 million on this. But you can see kind of the general cost. And yes, debt service is high because this is going to take us 3 years to finish both phases. But it gives you a nice idea, and it correlates into something that John and I have focused on, and we talk about a lot on social media: blending your capital stack. How much is it going to cost you to actually, annually do what you want to do? And so our blended capital stack in a market that's seeing very, very high increases is 8.58%. So that is a great capital stack blended rate if you're looking to do development. It's actually not a bad rate if you're trying to find C-class right now. We've seen rates as high as 10.5% for value add from bridge lenders. Next slide. Promise you guys, we have 2 slides left. And then we wanted to throw in, because we do have people already asking, again, not really a solicitation. You can click on the early commitment, sign up right here. I think Jeff put the link in the chat box, or you can email us later if you want to, sign up. Most people that are on here have worked with, especially John and I previously. Typically we'll do a webinar. We just don't have a date on it yet. We're trying to get some finalized numbers. But we'll do a webinar, and then the next morning at 9 a.m. you get an email. And yes, it is a frenzy for those that have invested with us in the past. We always tell people it's first come, first in, and there's a good chance that we'll oversubscribe. Our last one, we oversubscribed very, very early. But to give people an idea, we're trying to give people a heads up. These are the 3 classes. These will be fixed returns. Okay, so we like this because we've got a fixed rate and we have a fixed return, and that's a preferred return, meaning that that return goes to the investor before management takes any part of the profit. So that's a big deal. So we're trying to de-risk a number of buckets, 4 of them, and now we're also trying to de-risk or we're sensitive to the risk of investors not getting what they're expecting to get. So unless we can't pull a 22% return, and we should be should be easily able to exceed that based on the cost to build and our rent pro forma. But as you can see, more money gets a higher return. That's on an annualized basis. You can see the returns below. You do have advantage. You do get to take advantage of the tax deductions, assuming the entity you're investing in is an entity that's available for it. We will have a phase 2. The phase 2 is going to be a very small return. Again, I could speak for an hour and a half on PACE, but we get more PACE proceeds for phase 2 than phase 1. Really quick, high level. And I'm not an expert on PACE, but I have learned a lot over the last 3 weeks. PACE is based on improvements only. So phase 1, we're buying the land for the entire project, and we're doing the horizontal work for the entire project. So none of that expense is included in the way PACE calculates their loan. So I think they can loan up to 30% of the improvements on the property, provided they meet certain green requirements, and ours will meet the green requirements. So the percentage they're able to give us on phase 1 is a lower percent than phase 2, because phase 2 is all construction. It's all improvements, because we would have already built out, we've already paid for the land, already paid for the horizontal. So the raise on the second one is probably going to be closer to 3.5, 4 million. The raise on the first is about 12.5 million. So anybody that comes in phase 1, when it's time to capitalize for phase 2, which would be about 2.5 years, they have the right of first offer before we either capitalize ourselves or seek outside capital. But it will be a small raise. Again, everything is paid prior to sponsor getting paid, and no, we're not accepting 1031s on this particular deal. And then slide 24. So lovely picture. You just have to be able to imagine that in the background. I think those of you that got on early were able to see a video that we put together that's a drone of kind of what's going on in DFW as a whole, and what's going down from a market and submarket perspective. And then we have kind of the cartoon version of the site plan overlaid, so you kind of see how everything is. That's actually our property. That's the Princeton Water Tower. And John's not smiling because he thinks he's getting chiggers. We just took this picture last week. He's wearing shorts, and so he's not smiling because he's afraid of bugs, but he's shaking his head. So anyway, long story short, we thought it was important to just start talking about it at Revision Masters. We're always fielding questions, happy to talk to people about development. We're helping some people that are even partners with ours on how to finance their own deals and who to go talk to and what works. And we're serious about everybody on here that finds opportunities. John and I are going to look at another opportunity on Monday in the Austin area, and then we're looking at another one in the far North Dallas region. Next Friday, we're going to go discuss it. So there are lots of opportunities, and again, these are coming to us from good clients or good references, and there's a lot of opportunity out there for people that can get a good team together, have excellent, we didn't talk about this at all. We will on our Raise webinar, but have excellent professionals. Your engineering firm and your architectural firm are absolute key to what you're doing. There are a lot out there, but there are a lot of hard ones to find that have similar values, similar ethics. Just like picking a partner, you should be picking your engineer and architect firm. And just so you guys know, we use the same engineering firm on 5 of our deals right now. The only reason we don't on the other 3 or 4 is because someone brought us into the deal and they'd already engaged an engineering firm, but we have our same architectural firm on every project we're in. And you also have to make sure the kids play well together. So many times you get an engineering firm and an architecture firm that don't play well together. They have egos, or one wants to lead. So there's a lot of components that go to doing the development. And I'm going to stop rambling in a second. But there's a lot of components in doing the development. And then we also retain an owner's representative as another professional that acts like our own GC overseeing the GC. So we have multiple eyes looking at this at all times and multiple boots on the ground. I'm going to go through a few questions real quick. Does Princeton Landing deal accept 506B? No, we do not accept 506B. Just 506C accredited investors. Fixed return meaning no upside on sale if you get a better than expected price. That is correct. Fixed return is exactly what it means. Fixed return, no upside, no downside. But the return of, if you invest 250K, a 22% return on new development annualized is very good upside. And there's always the possibility that there's nothing left for the GP. I find that to be a very slim possibility, but there is that possibility. I think I have answered. There's a question. I'm not sure I know how to answer, but I'll read it. How hard would it be to tear down an old out-of-code apartment complex at a prime location to develop Class A+++? Are there more challenges than ground-up development? Would it be lesser effort, faster, blah, blah? Okay, so I'm going to give you an excellent answer. It depends. That's the lawyer answer. Tearing a building down is probably not going to be that hard. That will be new development. So there's no question about it. If it's an older building out of code, regardless, it's going to be zoned a certain way. So you're probably going to want, if you're going to want to maximize it, depending on the size, you're going to probably have to go through some sort of zoning again, just like you were doing new development. And that would be infill. So like if you're inside the city of Dallas, for example, things move much, much slower in the city of Dallas and can be very expensive. Just like the city of Austin, we like to go in areas that are called ETJs, extraterritorial jurisdiction. So kind of like where ET used to live, if you're from the 70s or 80s, outside, the universe, not really. Basically, you have city limits, and then any property that resides outside the city limit is typically considered ETJ. So there are many times less restrictions. The flip side is there are less restrictions. You can do more design and more units per acre. However, you run the risk of not having utilities. You run the risk of not having sewer. So there's trade-offs with everything. But like in Austin so far, we have done ETJ. There's a big difference between being in Travis County and being in the city of Austin. Both have heavier restrictions than normal, but any of you that live in Austin know that Austin has much greater restrictions. We don't have to, move the building because we're going to disrupt a colony of flies that might be on the side of a tree. And we couldn't move the tree anyway. So we do look for, kind of easier paths of progress. And as John always says, ROE, return on effort. So I'll leave someone just zoning in Austin sucks. That's a good answer. One last question. Why do we want to sell the new building after stabilization? We don't necessarily. And so I think I had mentioned in there, we don't necessarily want to sell the building after stabilization. It's an option. We have several options. But as most people say in real estate, everything is for sale for the right price. And so we don't know what will be going on in our personal lives, in our investors' lives, the economy, whatnot, at the time we're finished. We can project, but we don't know for sure. So we want to always make sure we have plenty of options. Are these lands ag exempt when you acquire them and then you change them to multifamily, or are they typically already zoned for multifamily? The answer to that from our perspective, most of the properties we pick up are ag. Sometimes, twice we've been lucky and there's already some sort of multifamily zoning in place, but the vast majority of these are ag. I hope that answers the question. John, Anna, any final words? Let everybody go watch football.
Yeah, I just want to thank everybody for spending some time with us this evening. If you're an investor looking at potential opportunities in the new development space, whether it's with us or with anybody else, hopefully the information we provided tonight has provided you some information on how to analyze an opportunity with these deals that are put in front of you. If you are somebody that has access to land or a connection to landowners and need some advice or would potentially like have a conversation with us on partnering, we're happy to have those conversations as well. Hopefully there was a bit of value that we've been able to add tonight. To look forward to staying in touch with everybody. I'll hand it over to Anna to wrap up.
Great. Thank you so much. It's been a pleasure to be here with y'all and to teach you a little bit about what we're doing. If you have any questions, you can reach out to Merrill, John, or myself. We're an open book and always available to you if you have any questions. So thank you so much for coming tonight.
Everybody have a great evening.
Appreciate it.